We've heard about the policy, we've heard about an overview. What we really need now is to think about record keeping. Yay! No. So this is a map of my brain. If only it was this ordered. So we've heard a lot of concepts. So what does that actually mean? We've heard a lot. So from the moment you start up your company and you get your IP, whether by acquisition or what, from a licensing deal or whatever, you need to think about, well, is it IP? Is it qualifying rights? And do I have active ownership? Do I meet the ownership conditions? Am I going to be able to use the patent box in the future? Do I have the right basic building blocks? Have I got the right kind of right? Do I own it in the right kind of way? And am I doing the adequate development work? Do that from the beginning. Ongoing, because of these new nexus requirements, we have to think about our tracking and tracing. So tracking is the expenditure. Tracing is what assets that expenditure relates to. So am I going to a product family, or even the IP asset itself? What do I think? And this isn't going to be set in stone, but you need a basic idea. How is this patent going to turn into income? So how should I track the expenditure? Is it a product by itself? Is it all of oncology? Is it? Then we need to think about, when do I make a claim? So it probably won't be a startup. It might be, but at some point you're going to have to make a claim. That's a kind of an ongoing. When you do your tax return, do I claim for patent box? The big clue is whether you have any profit. And then these two are the tax return. So if you're actually claiming patent box benefit, how do I calculate the profits, and how does the deduction fit into my tax return? So I'm going to talk a little bit more about these two. What does the record keeping mean, and when do I make a claim? We've touched on both of these before. So your record keeping, this is actually tracing and tracking. So your lowest level practical. If you can track to an individual patent, you're supposed to track to an individual patent. If you can't track to an individual patent, you're looking at products or families of products. To be able to track to a product, the product has to have more than one patent. Yeah, that should be low. For a biotech, it's probably going to be project level, but it might not be, because you might have the same drug candidate with different targets. So you might have an immunosuppressant, it's being used, you've got a project running for psoriasis and you've got a project running for Crohn's or something, but it's the same asset. In that case, those two projects probably come together, yeah? Because you're tracking the core asset, the core patent. But what if you've got expenditure is relevant for multiple projects? Maybe you've got a platform technology, yeah, and so you're spending on the platform, and then you have assets spun out of that. We think you can double count. Yeah.
Yeah, you can.
Yeah. So if you've got, but you have to be consistent. You can't pick and choose when it's going to be. When you think, well, actually, this is my own IP, my own R&D, so that's good. So I'll double count that, and that's an acquisition, so that's bad, so I won't double count that. You can't do that. You have to be consistent. What if a project's abandoned? I think the OECD say you don't include unsuccessful R&D. But it's what's unsuccessful R&D, because even if it's a project abandoned, there's probably spend in there that does contribute to other assets or other projects that are still ongoing. It's a big web. So what do I track? So I work out what I'm tracking. I look at my future income stream and I work out my bundles, my little parcels. And what do I track to those parcels? And we've been through this. You can tell this is my slide because it's got qualifying and non-qualifying. And it's your usual R&D headings: staff costs, consumables, software, subcontracting, clinical trials is missed off there, and your non-qualifying, and this, right, so the fraction is cumulative, as David said, for 20 years. Tax records, well, yeah, you can open tax records. You're supposed to keep your tax records for 20 years. Fraud or negligence, you can still open a tax return, but it is quite a long time. And so a new entrant, you're tracking from July 2013, all your others from July 2016. So you're going to be following this expenditure for a long time, which is why putting it in the tax return. Anybody that does tax, I don't know whether you've had the joy of trying to work out the base cost of an asset that you purchased 30 years ago and finding the old files and the old letters and when we typed everything and it wasn't on the computer. To avoid that, that's why you keep the cumulative fraction going every year. And if you're doing R&D claims, it's another line on the spreadsheet. The tricky bit is working out at what level you're going to trace it. So this is what we said about making an election. When should I elect in? The magic accounting period. Accounting periods beginning before 1 July 2016, because this is when the rules change. So if you've got an accounting period ended 31 December, you've got until 31 December 2018 to elect in if you want to get into the old rules. These are basic rule of thumb. If you elect in, which might be electing in early, is if your nexus fraction will reduce your benefit. So if you are going to have problems with the nexus fraction, you've got a massive acquisition spend, or you've got, what's probably more likely here, you've got massive R&D from connected parties, it's going to really reduce your benefit. Then you would elect in early to get into the old rules. Don't elect in if you're making losses. You don't have to, or if the nexus fraction isn't going to make any difference to you. The time this will come up is when you file your when you're preparing your 2016 tax return and tax computations. That's the time to look at this. We thought about some scenarios that people might be interested in. Feel free to change them or say you're not interested in them. So, milestones, bumpy profits. This has already come up a bit. So you might get profit one year, a loss another year, and then another profit. And we've already just touched on the fact that losses reduce patent box benefits. Got some slides. So this is a patent box calculation. So you've got a milestone in year 1, a little bit of income in year 2, and a milestone in year 3. And you can see in year 1, we end up with a patent box tax deduction. In year 2, we have a patent box loss because our expenditure exceeded our income. And in year 3, which on the face of it is the same figures as year 1, we get less of a patent box tax deduction. We get less benefit because this loss we incurred in year 2 reduces our year 3 benefit. So, what happens if your IP is held separately to your R&D activities? So we've seen, over the last few years, there's been a big push to protect IP by putting it in a silo company. So you have your IP separate to your R&D. I think that the theory is that people with a legal claim can't then get at your valuable patents. That doesn't work under the new rules. Because if IP Co owns the IP, R&D Co does the R&D, IP Co's nexus fraction is 0 because it doesn't have any of its own spend. Well, it might have a few management level spend, but the bulk of its spend is on subcontracted R&D to a third party. In this scenario, so this is your ASIC-centric scenario, where you've got an IP platform, maybe, and then you've got a company carries on all the activities, got multiple projects, you spin them out into different IP codes. So you might have IP codes for different products or different uses of a drug, but they all subcontract for the R&D into R&D Co. So the idea is that you can get new investment into IP Co. And here, because where you've got common control, if you've got this common investor group, you are connected. So this R&D is non-qualifying spend. It's R&D with a connected party. So has anybody got that situation? Has anybody got where their IP is separate? Or, because yes, talk has gone.
Yeah.
There are some things you can do. You think, because you think, we just want to get it all back together. So you could transfer your R&D back to the IP Co. IP Co still got historical non-qualifying spend, but you're going to be from, if you're tracking and tracing from 1 July 2016, it's not got that much spend. Yeah, if the earlier you do this, then the earlier your spend gets back into the good category. Your other thing you could do is you could transfer the IP. The IP might not be worth anything, so you might not have a very high acquisition cost if you're still if you're not in the clinic yet or it's early stage IP. But you do have, that means moving your patent, so you've got re-registration costs, you've got the legal costs of moving your patent.
Can you not just do an exclusive license?
Yes, you could. The other thing you can do is you can elect in early to apply the old rules. So if you've got a share sale, this happens sometimes. So if you're selling shares, the patent box doesn't apply to the vendor because you're not selling. You've not got income from the IP. You've got a capital gain on the sale of shares. But the purchaser is acquiring the corporate history of the target, so that includes its tax history, which includes its nexus fraction, its R&D fraction that we've been discussing for the patent box. So you're going to have, the questions will arise of, have you elected into the patent box? Can you elect into the patent box? What is your nexus fraction? And even if it's not going to make any difference because you've got an early stage asset which still has to be put through phase 3 trials before there's any income, and so the spend is going to be massive, it's still going to come up at due diligence, and it's still a potential point for negotiation. It's also something that's much easier to deal with on a cumulative basis than it is when that question is asked in a data room. Okay? So it's just something to be aware of, and it's another reason for it to go into tax computations and to think about it now rather than just thinking, well, we're going to do a share deal. Yeah, we're not doing an asset, we're going to do a share deal, so we don't have to worry about patent box because it will come up.
Yeah.
And as an asset sale. So here, patent box is relevant to the vendor because you're selling an IP asset, so you can hopefully get the reduced rate. But for the purchaser, they've got acquisition spend on an asset, which will be non-qualifying spend. I refuse to say bad. So how much of an issue is that? Well, if you're an early stage drug and you're selling to a purchaser who's going to develop through to market, they're going to have a lot more spend. Yeah, and plus you've got this 30% uplift on your qualifying spend. So hopefully it's not an issue, but it might be, and it's all up for negotiation, isn't it? And what if the purchaser wants to split the consideration and say, well, actually, I will give you 10 million for the patent and 10 million for the know-how. So then, for their purposes, the acquisition spend, the bad spend on the patent is 10 million. But that affects the patent box position for the vendor, presumably, because you've only got 10 million income from the patent. So we might see this coming up more, we might not, and again, it's a point for negotiation on the deal. If you know you've got an early stage asset, and you know there's going to be a lot more spend on that asset, how much leeway do you want to give? What's worth noting with an asset sale is there are specific provisions for transferring of a trade. So if somebody disposes of an asset and ceases carrying on a trade in respect of that asset, and somebody else acquires the asset and starts to carry on that trade, the nexus fraction and also the grandfathering position, so old or new rules, is inherited by the purchaser. So if a trade transfers rather than just an asset, which is useful for especially in intra-group situations where you might be more likely to hive trades around. Okay, so what happens if you factor unusual? The legislation is very long and very complicated and doesn't apply to lots of situations you might get in don't fit neatly into it. It's not unusual to wonder how you fit into the legislation. So the main thing is to seek advice. The benefit is worth it. It could be 10% of an asset deal, yeah, that you will be paying an extra tax. So your benefit is 10% of the deal. So it's worth looking into, and it's worth getting advice. And support is available from HMRC. So the manuals online, there's lots of guidance been published, and as you say, if you can actually approach your contacts, that's handy.